All right, let's talk about a huge mistake that keeps so many people from actually building wealth. It's doing things in the wrong order. See, it's not just about what you invest in, it's about when. If you get the sequence right, you build wealth like a machine. But if you get it wrong, well, you could be losing money and not even know it. So today, let's get it right.
Okay, I want you to picture your financial life as a bucket you're trying to fill with water. A lot of people just start pouring money into investments. That's the water. Well, they're completely ignoring these massive holes in the bottom of the bucket that are draining them dry. It's so frustrating, and you know what? It's a losing battle.
And this quote just hits the nail on the head, right? That's the whole problem in a nutshell. You could have the most brilliant investment strategy in the world, but if you're losing money faster than your investments can grow, you're just spinning your wheels. You're not making any real progress. So, you know what? Let's ditch the leaky bucket metaphor. Let's think about something more constructive. Let's talk about building a financial house. You would never, ever start putting up the walls and the roof before you pour a solid foundation, would you? Of course not. The exact same logic applies to your money. So let's look at the blueprint for building it the right way.
First things first, we have to look at the problem head-on, the cracked foundation. Before we can start building anything, we really need to understand why the way most people do things is, well, it's just broken. And the numbers, honestly, are pretty shocking.
The median emergency savings in America is just $500. $500! I mean, just think about that for a second. That's not even enough to cover a major car repair or a surprise trip to the emergency room. This is living on a financial knife's edge, where just one tiny emergency can throw your entire life into chaos.
And here is one of the biggest holes in that financial bucket we were talking about. The average U.S. household is carrying over $9,000 in credit card debt. That is not a small leak, my friends. That is a fire hose, just blasting your money away every single month.
And this right here is exactly why you can't outinvest this kind of debt. It's just simple math. The stock market, on average, historically returns around, say, 7 to 10% a year. Awesome. But the average credit card, the interest rate is over 20%. You are mathematically guaranteed to lose more money to interest than you can reasonably expect to gain from investing. It's literally like trying to run up an escalator that's going down. You're just not going to win.
Okay, enough of the scary stuff. Let's start building. Step 1 is all about pouring the foundation. Now look, this is not the sexy, glamorous part of building wealth. I get it. But it is, without a doubt, the single most important part. You get this right, and everything else we talk about becomes possible.
So, how do you pour a solid foundation? It really just boils down to 2 non-negotiable steps. First, you build a small starter emergency fund, at least $1,000. Then, you keep going until it covers 3 to 6 months of your basic living expenses. Second, and this is crucial, you eliminate all of your high-interest consumer debt. I mean, every last penny, gone.
So what exactly do we mean by high interest? That's a great question. A really solid rule of thumb is any debt with an interest rate over 8%. So we're talking about credit cards, personal loans, those awful payday loans, you name it. This kind of debt is your #1 financial enemy. You have to destroy it.
All right, the foundation is solid. Now we move on to step 2, which is my favorite part, claiming your free money. Seriously, think of this as a big truck pulling up to your construction site and just dumping a whole load of free building materials. You'd be crazy not to take it, right?
This brings us to the magic of an employer 401k match. If your company offers to match your contributions, you have to take it. It's an immediate 50 or even 100% return on your money. Instantly, guaranteed. No other investment on planet Earth can promise you that. You absolutely have to contribute enough to get the full match. It's free money. Don't leave it on the table.
Okay, the foundation is secure, you've grabbed all your free money, now it's time for step 3. This is where we get really smart. We're going to build the frame of our financial house using special accounts that protect it from the weather, and in this case, the weather is taxes.
So here is the exact sequence, the playbook. After you're getting that full 401k match, the very next thing you do is max out an individual retirement account, an IRA. We prioritize this because IRAs usually give you way more investment choices and have lower fees than your typical 401k. Then, if you're eligible, you max out a health savings account, or HSA. Only after both of those are full do you go back and put more money into your 401k. That's the order.
Now, when you open these accounts, you'll often see the choice, traditional or Roth. What's the difference? It's actually a pretty simple trade-off. With a traditional account, you get a tax break today, right now. With a Roth account, you pay the taxes now.
But then all of your growth and all of your withdrawals in retirement are 100% tax-free.
Now, let's talk about the Health Savings Account, the HSA. People call this the superhero of investment accounts. And honestly, they're not wrong. It has this unique, incredible, triple tax advantage. Check this out. Your contributions are tax-deductible, the money grows completely tax-free, and your withdrawals for medical expenses are also tax-free. It is the only account in existence that does all three. It's amazing.
So, let's recap. You've built an incredibly solid financial house. You've filled up every single tax-advantaged room that you can. Now, and only now, is it time for step 4, the finishing touches.
This finally brings us to our last stop, a standard, taxable brokerage account. These accounts come last for a reason. Yeah, they offer incredible flexibility, but you have to pay taxes on your investment gains and dividends all along the way. That tax drag is like a tiny anchor, just slowing down your growth year after year. And that's exactly why we fill up all those tax-sheltered accounts first.
So why? Why does this specific order matter so much? Because when you follow this blueprint, you're not just building a house, you're building a fortress. So let's look at the payoff, the absolutely incredible milestones you can hit when you follow this process. This is where it gets really exciting. You know, your wealth-building journey really accelerates over time. Getting to your first $100,000, man, that is the hardest part. It feels like a grind because it's mostly funded by your savings. But then, something magical starts to happen. Compound interest kicks in. Around the $650,000 mark, your investments can actually start generating passive income that rivals a median salary. And once you cross that $1 million mark, you feel like you've won, because compound interest is now doing almost all of the heavy lifting for you.
So there you have it, the blueprint. The step-by-step guide to building wealth in the right order, from pouring that solid foundation to watching your own personal skyscraper grow. The path is crystal clear, and the math is proven. The only question left is, are you ready to start building?